Since the 1960s, SACCOs have been the force behind financial inclusion, especially for those unable to access loans from banks. Although they initially had restricted membership to specific sectors, such as teachers or the police, they have expanded to include the general public and have become central to a culture of saving and investing that runs deep across the country. This week, we examine how SACCOs promote regular saving and responsible borrowing, helping millions to build wealth one contribution at a time.
Also, today on Mint, motor insurance. What to look for before you buy to make sure you're always covered when you need it most. A new wave of technology is giving people a choice. We explore the booming business of laser tattoo removal. Turning wanderlust into profit. Linda Abuto's travel success secrets.
Earn it, spend it, save, invest. Earn it, spend it, save, invest. Mola, kila siku niko chesa. Mola, make more bila stress. Mola, kila siku wesa. Mola, make more bila stress.
This week on Money Moves, we explore how SACCOs are built on a simple yet powerful idea. People coming together to pool their money in a collective fund, save consistently, and access affordable loans, whether for school fees, buying land, or starting a business.
Earn it, spend it, save, invest.
If there's one thing Kenyans understand, it's the power of pulling together. From chamas to SACCOs, it's a system Kenyans have used for years that is built on savings, trust, and collective growth. While the chama kitty might help you furnish your home or buy a cow, a SACCO takes it a step further and transforms savers into homeowners, business owners, and investors. Let's understand how SACCOs work.
A SACCO, as the name suggests, it's savings and credit. So members come together, they save money, and a member borrows under the terms that the SACCO prescribes, depending on the product the member wants. It could be short-term financial needs, whereby you can get things like school fees loans, emergency loans. It could be long-term, we have development loans and the like. And it could also be facilitation in the market, trade financing, things like buying cars, as well as buying things that you normally use, assets for use, let's say cars, it could be trucks, machines.
But before you qualify for benefits, you need to pay a joining or membership fee and a monthly contribution, which vary from SACCO to SACCO.
For all SACCOs, there is a minimum saving level. For Nation SACCO, it's 2,000. There is also the registration and the membership fee. Once you pay those, you save at your own pace, so long as you are meeting the minimum of 2,000. In order to accommodate people who have irregular income, we mostly require that members, at least in a year, put in 24,000. So it's the minimum you need to save for a year in order to qualify for benefits of the SACCO, mostly dividends and rebates.
To qualify for credit facilities, most SACCOs require you to save consistently for at least 6 months for long-term loans and 3 months for short-term loans. However, once you apply for it, a loan must be fully guaranteed.
And after that, you are given facilities ranging from ×3 up to ×5 of your savings. But really, it depends on members. If a member does not want to have guarantors, that member can even borrow within the savings so that you are taking less than your savings. But most of the choices really are with the member and the ability to pay. Apart from the ability to pay, there is also the issue of getting guarantors. And if you are not able to get guarantors, we now allow members to change properties, mostly land and buildings in good urban centers and shopping centers, as well as cars. And any other assets that members have can also be considered.
Members are usually encouraged to borrow loans for income-generating purposes to ease repayment and prevent defaulting or being listed on CRB. Unfortunately, the pandemic led to massive job losses, which hindered SACCO members from continuing their monthly contributions.
The experience during COVID showed that we need to interact with the members more to hold members' hands to support them. And we did that through, after the retrenchment, we invited members to come and discuss, and we were able to restructure their loans to a level that they can afford to pay, even with the loss of their one source of income. In 2020, we restructured about a fifth of our loans. 300 million we restructured for members, and the members were able to pay. Those efforts are reflected in our bad debt position, non-performing loans, falling from 16% during COVID to 10% now. Now it's at around 10.5%. So those efforts of engaging members to see how we can assist them, how they can repay their loans despite whatever happens to their jobs, has helped a lot. The other thing related to that is to appeal to our members. When you borrow money, please put it in something that can give you income when the unexpected happens. Kenya is a hustling country. We have really made the hustle a big one in Kenya. So we encourage members to have side hustles so that even if they lose their employment, they have other resources that can enable them to pay the loans and also enable them to get by as they look for other alternatives as they think of what to do next.
Joining a SACCO is the easiest form of investment, which can help you achieve your dreams through affordable credit facilities.
Car insurance is not something that you buy in a rush or later. It is mandatory under Kenyan law and therefore requires due diligence. Most local insurance companies offer different levels of motor vehicle insurance covers which are priced differently. You've probably heard one being asked about their cover and whether it's comprehensive or third party. Kenbright CEO Ezekiel Masharia helps us understand some of the factors to consider and understand before you buy a car insurance policy.
One thing people need to realize is the cost of repairing cars have gone up. Whenever you see that dollar going up, that means your spare parts coming into the country, which are priced in the dollar, are also going up. So some of those factors are eating into the insurance company's cost. If you look at general insurance, motor composes a third of that business. In fact, 20 years ago, motor was 50% of the market. And one of the key things helping motor is because we have a mandatory requirement to have motor insurance for our cars. And the mandatory insurance is not the comprehensive. I always tell people it's the third party which is comprehensive. The key benefits are, if you hit somebody on the road or you hit somebody's car, you get reimbursed. So that's really the purpose of the motor insurance. So the key thing people should check out is what is the insurance going to cover. I know insurance in Kenya has been, we call it commoditized, so it's just, the rate is X% without checking the risks. The insurance companies are getting wiser and they're a bit more innovative towards who should pay more. So we've started at the first level, which is value of car, because the statistics have shown the cost of repairing a more expensive car compared to the value of the car is lower than these other cars. And also type of insurance company you're working with. You also need to look at insurance companies who are profitable. If somebody is profitable, it means that they have money to listen to you in case you want a favor. We call it ex gratia, but sometimes it applies to more of the large corporates. But also, if you look at an insurance company that is profitable, they might be a bit more lenient on you. But if somebody is making losses because they didn't collect enough money to pay claims, it's not that they don't want to pay you extra, it's just that they don't have the money. The problem is that since motor insurance has a mandatory side to it, people tend to ignore the features. One of the areas people need to understand is that if you hit somebody on the road, it's you who has hit the person. It's not the insurer. So the insurer reimburses you up to what he promised you. So if, for example, you hit somebody on the road and they sue you for 5 million shillings, if your policy only pays 3 million, then that is what you'll get. You still have to pay the extra 2 million. You should be keen on checking, what are you really purchasing, because, and those are very cheap services. Some insurance companies charge you, like 1,000 shillings for every million extra. Some small amounts. So those small enhancements are the ones I would say consumers need to look out for. People need to check, what are my third-party property damage limits? What am I getting back if I hit somebody on the road? There are also areas where insurance companies look at your passengers. Let's say you're carrying somebody and then there's an accident. There are also some benefits where they cover you for legal costs because somebody might sue you. So legal liability there. Also, there may be other areas that consumers like to look at, like windscreen, But also the windscreen also has a limit. They might say we'll pay you 50,000 for your windscreen, but to replace your windscreen we need 100,000. Consumers need to understand that it's you who was on the road, it's you who caused the accident. The insurer is just coming to be your friend, to pay your bills. The first thing you need to know is that the insurance company, they ask you pay us 4 shillings in exchange for 100 shillings in case some rules happened. So now paying you back that 100 shillings is where the complexity comes in, and that is where the consumers need to know. Insurance companies prefer if you pay the small claims, and then the insurer only pays big claims, and it's just to make sure you're more careful on the road. So that is called excess. Now, if you want to not pay for excess, you buy an excess protector. The second one is insurance companies also look at cause. We have exclusions. For example, if you look at one of the key exclusions that insurance policies had, and this is historical, it's not a Kenya issue, but just globally, is things like war, civil uprising. So political violence and terrorism was one of the key exclusions that people are not covered for. So that one is an area that you need to look at buying back. Third area, which insurance companies like to upsell to consumers, is something called courtesy car. Courtesy car is simply assuming your car is in the garage, you can get a car, but then they base it based on number of days or the car value.
Motor insurance cover provides various levels of protection to the insured and other road users in the event of an accident or incident. It is therefore important to understand your policy before you sign on that dotted line. Let's take a short break. We'll be right back.
Coming up, we chat with Linda Abuto from Soleil Tours and Travel on what it takes to get into the business.
Earn it, spend it, save, invest. Moolah, kila siku waste